Hello guys, welcome to lessons. Today we're going to be doing cash flow statement. This video is mainly for is mainly for grade 12 students, but if you are a small business owner and you want to do your cash flow statement and you don't have funds to, employ an accountant, it's fine. You can stick around. The other thing I want to say before I start is this video, I would not do practical examples. I'm just going to be focusing on the theory behind it. And it is very important to know where the amount comes from so that you get it every time. Okay. Cash flow statement is a financial statement that summarizes the amount of cash and cash equivalents. In simple words, it measures how well the company manages its cash positions. So it's all about cash, right? How do they make their cash to pay their debtors? How do they finance the expenses? Okay. Cash flow statement is pretty long. Okay. And the perfect way to achieve it or to ensure that it's correct, you have to follow through with your notes. So do it note by note. Today we're going to be focusing on note 1, which is the reconciliation between profit before tax and cash generated from operations. That's it. Today we're just focusing on note 1. I'm going to upload other videos when I'm doing the other notes. Okay. Otherwise, it would have been a long ass video if I would do every note. Anyway, let's get through it. So this is the format for note 1. Okay, as you can see, there's profit before tax and then your adjustments in respect of depreciation, interest expense, profit or loss on sale of assets, your operating profit before changes in working capital. You get your changes in working capital, which consist of your inventory, your debtors, your creditors. Then you get your cash generated from operation. Don't worry, I'll go through each line item and explain where do you get the amounts, how do you get the amounts. Okay. So profit before tax, which is the very first line item. So grade 12 students, normally they would give you the income statement. That is the easiest way. You just take the profit before tax from the income statement and you just write it there as it is. But sometimes they like to add a little spice. It's not even spice, trust me, it's just salt. They will just tell you that your profit for the year was maybe like 20,000. Your tax expense was 10,000. What you can do is you just add back your tax expense to your profit for the year, and then you get your profit before tax. I don't think it can get any harder than that unless they have tricks on their sleeves, but it's probably the easiest amount you can get, the profit before tax. You just take that amount and you put it there, okay? Or you add the tax back if you are given the profit for the year. The second line item is the adjustment of the non-cash items, which is your depreciation, your interest expense, and sometimes your profit or loss on sale of asset. So for depreciation and interest expense, it's easy. You add it back because you would have subtracted it. Remember, depreciation is treated as an expense in accounting, so it's subtracted from profit. So you now have to add it back because it is not a cash expense. It is just an accounting method. Okay, it's an accounting treatment because accounting is so extra. So for depreciation, you would normally take it from your income statement as well, right? And interest expense. But sometimes, they always have a sometimes, you won't be given the depreciation. They'll just tell you the method and the value of the asset. The important thing to note when you're calculating your depreciation is to know whether this asset has been in the company for a full accounting period, right? You do not, at this point, you're not thinking about the other previous years because because you're not doing accumulated depreciation. No, you're just doing depreciation for the current year. So you need to make sure that this asset has been in the company for the full 12 years. Let's say a company has a 31st December 2020. You need to make sure this asset has been in the company from 1st of December, from 1st of January to the 31st of December 2020. Now, sometimes they can just like say that a particular asset, let's say a motor vehicle, was sold on the 30 within September and on the end at the end of September. Okay, at the end of September, the motor vehicle was sold. So the motor vehicle has been in the company for how many months? For 9 months. So you can only account for 9 months. You have to apportion your depreciation. So whatever calculation you're making, you have to multiply by 9 divided by 12. That is very important. Sometimes they may say that they bought machinery on the 1st of June. Now you know that this machinery has only been in the company for 6 months. You cannot account for the full 12 months. You have to account for only 6 months. Okay, that is very important to note. Remember that when you're doing your depreciation. Now, for profit or loss on sale of an asset, that is a calculation on its own, and it is achieved well when you're doing your T accounts. I'm going to have a video. I'm going to upload a video where I explain how you do that, because it's a pretty lengthy process. Not lengthy, but it takes a bit of time and practice. So I'm going to just upload a video on how you can do that. But if you know how to do it, and you've ended with, let's say they sold an asset during the year, and you have to calculate whether it's a profit or loss made on that sale, that is an accounting treatment as well. It is not a cash value. So if you made a profit on sale of the asset, you would have added it to your profit for the year. So for adjustments, you have to subtract it, and for a loss, you have to add it back. So your adjustments are your depreciation, interest expense, which you add, your profit on sale of an asset you subtract, your loss on a sale of an asset you add. That is simple. So you have your profit before tax, and you have your adjustments of the non-cash items. So these two give you the operating profit before changes in working capital. Okay, that's it. We've done this side. Now I'm going to the other side, where I'm going to be talking about your working capital. Your working capital is your inventory, your debtors or accounts receivable, your creditors or accounts payable. They normally give you, for accounting students, they normally just give you the figures of the previous year with the current year. This part was my favorite part in the cash flow from operating activities, note 1, because it's the easiest part. You normally have the amounts. You cannot assume that last year inventory was this. Or they will give you some information that gives out the inventory balance from last year, but I don't remember having that problem, I promise you. I always, maybe I was liking my year, but they always gave us the 2 different years for working capital. Okay, but remember to exclude amounts owed to shareholders, accrued interest, and amounts owed to or by SARS for income tax. But trust me, you normally wouldn't have that problem, but just remember it. Just keep it at the back of your head just in case you need it. Okay, so I'm just going to explain how changes in working capital works. Okay, so you see this part here, this part, right? You see that it has an increase or decrease, an increase or decrease, where increase is in brackets, and then for creditors the decrease is in brackets. So I'm just going to explain that part. So for inventory, if your inventory in the current year is more than the inventory balance in the previous year, What I mean is, if your inventory balance this year is 20,000 and last year it was 10,000, it means your inventory has increased. It means that no money is coming in your business. It means that you have more inventory, so you took more money out. That is a subtraction. So you have to put the difference between the current year and the previous year in the brackets. What I mean is, you have to say 20,000 current year minus 10,000 previous year. It's 10,000, and then you put it in a bracket. Okay? Now if it decreased, let's say in the current year it's 10,000, in previous year it was 20,000, it means somebody bought the inventory. There was money coming in the business. More money came in the business, you sold the inventory, more money. That means a positive. So if your inventory decreased, you take the difference between the current year and the previous year and you put it as a positive. Okay, debtors works exactly the same way, because for debtors, if your debtors balance increases, it means nobody paid, there was no money coming in, but you took something out of the business. I borrowed something and they didn't pay anything back, and that is a negative. So there was no money coming in, more money coming out. So if your debtors increase, you put it in a bracket, but if they decrease, it's a positive. It means the debtors actually paid you. They didn't take too long to pay you back. They pay you back your money, you have money in your business. So it is a positive. Now for creditors, it works kind of different. Excuse me. Because for creditors, if you don't pay your creditors, you have more money in the company. If you borrow more money, there's more money in the company. If you didn't pay, there's still more money in the company. So let's say creditors this year are 20,000 and last year they were 10,000. It means you borrowed a little bit more. And for that, that is a positive. There is more money coming in. So you say 20,000 minus 10,000, you put 10,000 as a positive. But if your creditors decreased, which is a good thing, by the way, but if your creditors decreased, you took money out of the business. You paid your creditors. So let's say last year's creditors were 30,000. This year's creditors are 10,000. You paid 20,000 to the creditors. So that is a negative because there's money coming out. That is a negative 20,000. So you take your operating profit before changes in working capital, you add or you subtract your changes in working capital, and then you get your changes, your cash generated from operation. Why am I making so many mistakes? I'm sorry. And then you get your cash generated from operation. So you take that value and you take that cash generated from operation and you transfer this figure to your cash flow statement next to the cash flow from operating activities, because that's what note 1 is about. Note 1 is about the cash flow from operating activities. Now grade 12s, it's important to say cash inflow or cash outflow. Those words are important because it tells the marker that you know what an outflow is and you know what an inflow is. Okay, so if your cash generated from operations are negative, then you say cash outflow from operating activities. But if they're positive, then you say cash inflows from operating activities. That is it from me, guys. I hope somebody out there learned something from this video. Remember to subscribe, I beg, and hit the notification bell because you're going to be notified when I upload my note 2 and other stuff that I promised you. Have a very lovely day. Happy studying, grade 12, and good luck.